guests right now. More on the bond market, the recession warning, and the Fed. We're joined now by University of California, Berkeley economics professor Brad DeLong, who's also a former deputy assistant Treasury secretary under Clinton, and Romina Boccia, Heritage Foundation's Center for Federal Budget Director. We're also joined by Jim Urio, who was commenting on bonds yesterday when we got some data, Jim, and talking a little bit about what this means for recession risk and when we could see that. But I want to start with you, Brad, because it's not as if unemployment is high. There are questions about whether the U.S. can continue to issue debt to pay its bills. So what is this actually telling you right now?
There are no questions at all about whether the U.S. can continue issue debt to pay its bills. Look at the interest rates on the debt. Look at how extraordinarily valuable the debt is. People worldwide think that holding U.S. government debt is an extraordinary good thing to do, and it has an extraordinarily high value. I don't understand why you can say that there are questions about whether the U.S. can continue to issue debt when everyone out there wants it and wants it at a very high price.
It's a high price compared to what they are getting for their money anywhere else around the world, Romina.
No, just high price in general. U.S. bond, create $1 of cash flow and sell it as a U.S. government bond, and it has a uniquely high value, save perhaps for Germany and Japan, where it's even higher.
Romina,
you're just talking relatively today, not relatively in life, because otherwise it doesn't have a high price at all.
It does too. Have 30-year Treasury bonds ever been this high?
The price is not.
No.
The price is not. It's Brad, real quick, how worried are you about this yield curve inversion?
Not the yield, the price.
Look, the market is honking the horn very loudly at the Federal Reserve. The question is, does Jerome Powell have a better sense of how to maintain the expansion, or is the market right to be worried? Given what we've seen over the past 40 years, you'd be well advised to bet on the market, and I think Powell is going to respond, which is why everyone expects interest rates, the 3-month rate now, to be 75 basis points lower in January than it is today.
But Romina,
someone's honking the horn at the economy, and the Fed is responding.
And the Fed responded in July, certainly. But Romina, how much longer do you think the Fed is actually able to expand or to extend this expansion?
You know, this is a really tough question, and ultimately the market is going to decide this. But the Fed shouldn't concern itself with facilitating fiscal policy for the U.S. federal government to enable this huge borrowing spree that we're witnessing. We're looking at potentially almost $1 trillion deficit this year, certainly next year. The interest cost alone will exceed what we'll spend on all of Medicaid at the federal level. And over just the next 5 years, it looks like interest on the debt may actually exceed what the U.S. federal government spends on national defense. So while the U.S. debt is still in high demand, we got to keep in mind who is backing that debt. It's the U.S. economy, it's the American people. And if things should turn for the worse, those interest rates could spike relatively quickly, and that could get us into real trouble fast.
One of the reasons, Romina, though, why President Trump has advocated for lower rates is so that the cost of government borrowing would go down because of the expectation that it would be issuing more debt. But what happens if we do go into a recession, if corporate tax receipts get lower? And does that offset any potential cost savings from low interest rates?
You know, the Federal Reserve, it should be independent. That's the whole purpose of having an independent central bank. We get in real trouble when they see their mandate as facilitating fiscal policy for a government that is spending out of control and borrowing at excessive rates. The fiscal situation is unsustainable, not just in the long run, but also in the short run. And that's a real problem. Now, we have to see what the markets will do, but I do worry that we're finding ourselves in a bubble, and the longer we try to extend it, the deeper that fall will be.
I want to ask Jim Urio, though, because, Jim, earlier this week you said that even when this spread goes negative, that if it portends a recession, it's not for 14 to 18 months. So when you look at futures and you see just this spread going negative, leading the Dow futures down by more than 200 points, 250 points, does that seem overdone to you?
Yeah, it does. It seems to me there was people waiting in the weeds for any little bit of bad news to come out and sell the stock market. And I don't think they're selling it because of the bad news. I think they're trying to find pockets of panic out there. And I think that's what we're seeing now. The whole thing, this discussion's gone on for 10 minutes or so, and nobody's mentioned the fact that the world's central banks have intentionally tried to compress long end rates over the last 10 years to the tune of, turning $15 trillion into negative yields. To me, then, when everybody's out there buying long end debt, creating money across the world to do that, and then you say, wow, long end yields are really, really low, that shouldn't surprise us as much. I guess my point is that there's some distortion. We can argue all day about how much distortion is in the yield curve, but there definitely is some. So to think, for me, that it's lost some of its predictive power, I think is completely reasonable if it's operating at a flatter pattern to begin with.
Steve?
Yeah, I agree with what Jim's saying, which is the next step to what Jim is saying, which makes me a little nervous, is central banks could reinvert the curve as a mission if they decided there was some sense to that. I'm pretty sure they're not there. In fact, Brad might know a little bit about the current state of thinking. But the idea of creating a positive slope to the curve, Brad, is not sort of one of the items in the Fed's playbook.
No, definitely not.
Right.
Definitely not.
Should it be?
I don't think so. I think what the Fed is in the business of doing is it's in the business of controlling short-term rates.
Right.
And then watching what the market then does with long-term rates and using that to assess the state of demand for investment.
Let's explore
That's
that
the
another
right
day.
thing for it to be doing.
Peter Fisher has an opposite opinion of that, thinks that for the banks and other reasons.